Three friends, Marcus, Leo, and Samira. Marcus is the hustler. He wakes up before dawn, glued to charts, chasing every flicker of price movement. His phone is full of screenshots of green days. Leo is calmer. He's not glued to the screen, but he still trades trends, holding for days or weeks. He believes he's smarter than the day traders, but still wants to time the market. Samira? She's the quiet one. She buys one low-cost index fund every month, closes the app, and goes back to living her life. No drama. No stories. Just patience. At the barbecue, Marcus brags about his wins. Leo debates market direction. Samira has nothing to say, because "I bought the index again" isn't a conversation starter. But here's the twist: over 30 years, the scoreboard flips. The loudest trader ends up with the smallest account. The quiet one, who barely lifted a finger, retires with the most wealth. That's the paradox we're unpacking today: why doing less often beats doing more in investing. Hi, I'm Della. On this channel, we simplify investing, personal finance, and wealth building so you can make smarter financial decisions without needing a finance degree. My mission is simple: to help you cut through the noise, avoid the traps, and focus on what actually builds wealth. If you're tired of hype, tired of gurus selling shortcuts, and you want clear, story-driven lessons that stick, you're in the right place. Subscribe, because today's story is one of the most important lessons you'll ever hear about money. Let's zoom in on Marcus. In the first couple of years, he looks like a genius. His account is flashing green. He's up 4% in a week while Leo and Samira are flat. He's convinced he's winning. And on the scoreboard he checks, week versus last week, he is. But here's the problem: that's not the scoreboard that decides who retires rich. The real scoreboard is 30 years long. And when you stretch the math across decades, Marcus's activity becomes his downfall. Why? Taxes. Every trade he closes is a taxable event. Short-term gains are taxed like his paycheck. That means every win loses about 20% to the IRS before it can compound. Friction. Every trade leaks value through spreads, slippage, and fees. A few cents here, a few cents there, multiplied by hundreds of trades a year, it quietly eats away at his returns. Overconfidence. A few good trades feel like skill. They're usually luck in disguise. And luck is expensive when you keep betting on it. Marcus doesn't see any of this. He just sees the green days. He feels like he's winning. But feelings and math are two very different things. Leo thinks he's smarter. He's not day trading, so he avoids some of Marcus's bleeding. His friction costs are lower. He's not chained to a screen. But the two biggest problems remain. He's still triggering short-term taxes. He's still trying to time the market. The data is brutal. Most people who try to time the market underperform the person who simply stayed in it. Leo bleeds less than Marcus, but he still bleeds. He's the cautionary tale that looks responsible but ends up behind. Samira, meanwhile, looks boring. She buys one index fund every month. She doesn't pick stocks. She doesn't time anything. She doesn't even check her account much. But here's what Samira wins on. Taxes. She almost never sells, so her money compounds untouched for decades. Costs. One low-cost index fund means no friction, no leaks. History. 9 out of 10 professional fund managers fail to beat the index over 15 years. If the pros can't, why would Marcus or Leo? Control. Samira decides when to realize gains. Marcus and Leo don't. It's boring. It's effective. And it's about to win by a margin nobody at that barbecue would have believed. For the first few years, the three of them look close enough that nobody can tell. Marcus still has the best stories, so it feels like he's winning. But by year 10, the gap opens. By year 20, it's not close anymore. By year 30, Samira retires with more than 3 times what Marcus built. And here's the kicker: Marcus didn't just lose money. He lost time. 60,000 hours spent chasing trades, the equivalent of a second full-time career, for a result worse than doing almost nothing. That's the real bill. And no return in any year ever pays it back. So here's the lesson: the market doesn't pay you for effort. It pays you for patience. Marcus felt like he was winning every week. Leo felt like he was being smart. Samira felt like she was doing nothing. But the scoreboard proves otherwise. And that's where we're starting this journey. In the next part, we'll dive deeper into Marcus's world, the adrenaline, the screenshots, the hidden costs, and why the very thing that feels like progress is actually the trap. Marcus wakes up before dawn. His phone alarm isn't just a wake-up call, it's a starter pistol. He brews coffee, opens his laptop, and stares at candlestick charts like they're treasure maps. Every flicker of green feels like opportunity. Every red bar feels like danger. He's convinced that the market rewards hustle. If he can just be faster, sharper, more disciplined, he'll beat everyone else to the punch. And for a while, it looks like he's right. In week 1, he nails a trade that jumps 4% in a single day. In month 2, he strings together 5 winning trades in a row. By the end of year 1, he's bragging in the group chat, "I'm up 20% this year. You guys are leaving money on the table." Marcus feels unstoppable. He screenshots his wins, posts them in chat, and tells himself he's building wealth. But what he doesn't realize is that the scoreboard he's watching, week versus week, isn't the one that matters. Every winning trade Marcus closes is a taxable event. And here's the kicker, because he's selling inside a year, every gain is taxed as ordinary income. That means his profits are taxed at the same rate as his paycheck. Roughly 20% of every win goes straight to the IRS before it can compound. Then there's friction. Every trade carries a hidden leak, the spread between buy and sell prices. Slippage when the price moves before his order fills. Fees that nibble at his account. On a single trade, it's pennies. But Marcus isn't making one trade. He's making hundreds. He turns his account over 20 times in a year. Even at 0.1% per trade, that's about 2% of his money evaporating annually, before profits, before taxes. And then there's overconfidence. Marcus believes his wins prove skill. But the data says otherwise. Most traders sell winners too early, hold losers too long, and mistake luck for talent. A hot streak convinces Marcus he's figured it out. But luck wears a costume, and the costume is expensive. Year 2 brings Marcus his proof. The market runs hot, and his trades line up perfectly. He beats Leo. He beats Samira. He even beats the market itself. For one glorious stretch, Marcus is the smartest guy in the group chat. He starts dreaming bigger. What if I quit my job and trade full-time? What if I scale this up? What if this is my ticket to freedom? But then the year turns. The trades that worked stop working. A couple of big ones go against him. And the IRS sends the tax bill. Every dollar of his gain is taxed at his full paycheck rate. By the time the dust settles, half of what he made is gone, some to losses, some to taxes. That monster year wasn't the beginning of something. It was the peak. Marcus doesn't know it yet, but he's already chasing a mirage. Marcus isn't alone. Studies across markets show the same brutal reality. Fewer than 1% of day traders earn reliable profits after costs. More than 80% lose money. In Brazil, 97% of people who day traded for more than 300 days lost money. In the US, the most active traders underperformed the market by about 6.5% every year. Not once. Every year. Even if Marcus is better than most, even if he's in the rare group that makes money, the math still doesn't work in his favor. Taxes, friction, and underperformance compound against him every single year. Marcus doesn't just lose money. He loses time. Think about it. He spends mornings prepping. Days glued to screens. Nights reviewing trades. Call it 2,000 hours a year. Over 30 years, that's 60,000 hours. The equivalent of a second full-time career. And what does he get for it? Less wealth than Samira, who spent about 120 hours total, 3 working weeks, over the same 30 years. Marcus paid with his money and his life. That's the real bill. Marcus's story isn't about stupidity. It's about math. He didn't lose because he was lazy. He lost because 3 forces ran against him every single day. The tax wrecking ball. The friction leak. The illusion of skill. And here's the cruel irony, none of it felt like losing in the moment. Every week, Marcus felt like he was winning. But over decades, those feelings cost him a fortune and a second lifetime of hours. That's the trap of day trading. It feels like progress. It feels like control. But the scoreboard proves otherwise. Leo doesn't see himself as reckless. He looks at Marcus, glued to screens, chasing every tick, and shakes his head. That's too much, he thinks. I'll be smarter. I'll be calmer. So Leo takes the middle ground. He's not a day trader, but he's not passive either. He holds positions for a few days, sometimes a few weeks. He rides trends until they run out, then moves to the next one. He believes he's found balance, less stress than Marcus, more opportunity than Samira. At first glance, it looks responsible. He's not chained to a desk. He's not making hundreds of trades. He's not burning himself out. But beneath the surface, the same problems remain. Leo's trades last longer than Marcus's, but most are still under a year. That means almost every gain is taxed as ordinary income. Just like Marcus, he hands over about 20% of every win to the IRS before it can compound. This is the silent killer of swing trading. Even when Leo wins, the government takes its cut immediately. Samira, meanwhile, avoids this entirely by rarely selling. Her money compounds untouched for decades. Leo believes he can time the market. He studies charts, looks for trends, and tries to catch waves before they crash. But the data is unforgiving. Most people who try to time the market underperform the person who simply stayed in it. Even professional fund managers, with teams and tools, fail to beat the index 9 times out of 10 over 15 years. If the pros can't do it, why would Leo? His calmer approach reduces stress, but it doesn't fix the fundamental flaw. Timing the market is a losing game for most people. Leo feels safer than Marcus. He's not frantic. He's not glued to screens. But he still falls into the same psychological traps. Selling winners too early, afraid the trend will reverse. Holding losers too long, convinced they'll bounce back. Believing that a few good trades prove skill. Confidence isn't evidence. And Leo's confidence keeps him in the game, even when the math says he's falling behind. By year 5, Leo's account looks better than Marcus's. He's around $68,000 compared to Marcus's $63,000. He feels vindicated. See? I told you I was smarter. But then the gap with Samira starts to show. She's at $75,000. Not a huge difference yet, but it grows. By year 10, Marcus has $134,000. Leo has $154,000. Samira has $192,000. By year 15, Marcus has $213,000. Leo has $264,000. Samira has $373,000. By year 20, Marcus has $302,000. Leo has $412,000. Samira has $656,000. Leo is ahead of Marcus, but miles behind Samira. His smarter strategy still bleeds value every year. Leo doesn't spend 2,000 hours a year like Marcus. But he's not free either. He spends evenings checking charts, weekends reviewing positions, and hours deciding when to move in or out. Call it a few hundred hours a year. Over 30 years, that's about 10,000 hours, 2.5 full work years. Samira? About 120 hours total. 3 working weeks. Leo spends years of his life chasing trades, only to end up far behind the person who barely lifted a finger. Leo's story is the cautionary tale that looks responsible. He's calmer than Marcus. He bleeds less. But he still bleeds. The tax trap, the timing trap, the psychological trap, they don't disappear. They just shrink. And shrinking isn't the same as winning. Leo proves that doing less than Marcus isn't enough. The real win comes from doing almost nothing at all. Samira's boring, relentless index strategy. Samira doesn't look like she's doing anything special. Every month, she opens her brokerage app, buys one low-cost index fund, and closes the app. That's it. No charts. No predictions. No debates. At the barbecue, Marcus brags about his hot streak. Leo explains his latest swing trade. Samira just smiles. I bought the index again isn't a story anyone wants to hear. But while her friends are chasing excitement, she's quietly building something far more powerful. Samira's strategy works because it aligns with the math of wealth building. Taxes, she almost never sells, so she almost never triggers taxable gains. Her money compounds untouched for decades. Marcus and Leo hand over a cut every April. Samira doesn't. Costs, one index fund charges next to nothing. No spreads, no slippage, no hundreds of trades leaking value. History, according to S&P's own long-running data, 9 out of 10 professional fund managers fail to beat the index over 15 years. If the pros can't, why would Marcus or Leo? Control, Samira decides when to realize gains. Marcus and Leo's gains arrive whether they want them that year or not. It's boring. It's effective. And it's about to win by a margin nobody at that barbecue would have believed. Here's the magic, compounding. Samira's money grows without interruption. Every dollar she invests stays in the market, earning returns on returns. Marcus and Leo interrupt compounding every time they trade, every time they pay taxes, every time they leak value through friction. Over decades, those interruptions add up to hundreds of thousands of dollars lost. Samira's uninterrupted compounding turns into millions gained. Let's line up the scoreboard. Year 5, Marcus $63,000. Leo $68,000. Samira $75,000. Year 10, Marcus $134,000. Leo $154,000. Samira $192,000. Year 15, Marcus $213,000. Leo $264,000. Samira $373,000. Year 20, Marcus $302,000. Leo $412,000. Samira $656,000. Year 25, Marcus $400,000. Leo $595,000. Samira $1,095,000. Year 30, Marcus $511,000. Leo $812,000. Samira $1,778,000. Samira ends with more than 3 times what Marcus built, and nearly $1 million more than Leo. Samira's strategy doesn't just win in dollars. It wins in lifestyle. Marcus spent 60,000 hours chasing trades, the equivalent of a second full-time career. Leo spent 10,000 hours, 2.5 full work years. Samira spent about 120 hours total, 3 working weeks. She built the most wealth with the least effort. She lived her life while her money worked quietly in the background. Samira proves the paradox of investing: the less you do, the more you win. Marcus felt like he was winning every week. Leo felt like he was being smart. Samira felt like she was doing nothing. But the scoreboard proves otherwise. Her boring, patient strategy crushed both of them. And the gap wasn't close. For the first few years, the 3 friends look close enough that nobody notices a difference. Marcus still has the best stories, Leo still feels smarter, and Samira still looks boring. But here's the catch: Marcus and Leo are measuring themselves against the wrong scoreboard. They're comparing this week to last week, this month to last month. Samira is playing a different game entirely, one measured in decades, not days. Year-by-year breakdown. Let's line up the numbers. Same age, same salary, same $1,000 invested every month. The only difference is their strategy. Year 5. Marcus, $63,000. Leo, $68,000. Samira, $75,000. The gap is small. Marcus still brags, Leo still debates, Samira still shrugs. Year 10. Marcus, $134,000. Leo, $154,000. Samira, $192,000. Now Samira is nearly $60,000 ahead of Marcus. The quiet one is pulling away. Year 15. Marcus, $213,000. Leo, $264,000. Samira, $373,000. The scoreboard isn't close anymore. Samira is more than $150,000 ahead of Marcus. Year 20. Marcus, $302,000. Leo, $412,000. Samira, $656,000. Samira now has more than double Marcus's wealth. Year 25. Marcus, $400,000. Leo, $595,000. Samira, $1,095,000. The gap turns almost cruel. Samira is nearly $700,000 ahead of Marcus. Year 30. Marcus, $511,000. Leo, $812,000. Samira, $1,778,000. Samira retires with more than 3 times Marcus's wealth, and nearly $1 million more than Leo. Notice how the gap opens. In the first 5 years, it's barely noticeable. By year 10, it's visible but still feels manageable. By year 15, it's undeniable. By year 20, it's devastating. By year 30, it's game over. The separation doesn't happen in one dramatic moment. It happens quietly, relentlessly, through compounding. Marcus and Leo never see it coming because they're too busy watching the wrong scoreboard. Marcus feels like he's winning because he has stories. Leo feels like he's winning because he's calmer. Samira feels like she's doing nothing. But feelings don't build wealth. Math does. The irony is brutal. Marcus worked the hardest, spent the most time, and ended with the least. Leo worked less, but still spent years of his life chasing trades, only to end up behind. Samira barely lifted a finger, and she won by a landslide. This is the moment the scoreboard flips. The loudest trader ends up with the smallest account. The quiet one, who barely lifted a finger, retires with the most wealth. The lesson is clear: the market doesn't reward activity. It rewards patience. Marcus and Leo measured themselves against the wrong scoreboard. Samira measured herself against the only one that matters: decades of compounding. Money isn't the only scoreboard. There's another currency Marcus and Leo spent heavily: time. Marcus, roughly 2,000 hours a year glued to screens. Over 30 years, that's 60,000 hours. The equivalent of a second full-time career. He worked a second lifetime chasing trades, and finished last. Leo, a few hundred hours a year checking charts, managing positions. Over 30 years, about 10,000 hours. 2.5 full work years spent. He worked less than Marcus, but still gave away years of his life. Samira, about 4 hours a year. A few minutes each month to buy her index fund, plus an occasional glance. Over 30 years, roughly 120 hours. That's 3 working weeks total. She lived her life while her money quietly compounded. The contrast is brutal. The man who worked the hardest finished last. The woman who barely lifted a finger finished first, with over $1 million more. After 30 years, here's where they land. Marcus is day trader $511,000. Leo, swing trader $812,000. Samira, index investor $1,778,000. Same income. Same contributions. Same timeline. The only difference was strategy. Samira ends with more than 3 times Marcus's wealth, and nearly $1 million more than Leo. Marcus felt like he was winning every week. Leo felt like he was being smart. Samira felt like she was doing nothing. But the scoreboard proves otherwise. The trap was never trading itself. The trap was mistaking activity for progress. The market doesn't pay you for effort. It pays you for patience. So what actually works? Build your core wealth in low-cost index funds. This is where the math wins: lower taxes, lower costs, broader diversification, and a historical record the professionals can't beat. If the urge to trade is real, wall it off. Take a small slice, no more than 5% of your portfolio, and let that be your casino. Trade it, learn, scratch the itch. But keep the other 95% boring. Be honest about the scoreboard. Measure your trading against the index, not against your best week. And count your time as a real cost, because it is. And just before we close, let me tease the next story. What if instead of trading or indexing, someone had simply bought one great company 30 years ago and never sold? The math might surprise you. That's coming up next.